November 2nd, 2021. Zillow Group issues a press release. Buried in paragraph 3, the company is destroying itself. Not figuratively, literally pulling the plug on a business unit it spent 3.5 years building. A business that had generated $1.2 billion in revenue in a single quarter. Gone. 2,000 employees. Gone. $304 million in inventory write-downs recognized in Q3 alone. Another $240 to $265 million expected in Q4. Total damage, north of $500 million on the homes business. More when you count restructuring costs. Here's what the company told shareholders, verbatim. They had been unintentionally purchasing homes at higher prices than our current estimates of future selling prices. Unintentionally. The most visited real estate website in America, a company with 227 million monthly users, a company that had been estimating home prices since 2006, did not know what it was paying for houses. The algorithm ate the company, and nobody saw it coming. That is what we are here to examine. Let's establish what Zillow actually was before it tried to become something else. Zillow Group, NASDAQ, Z and ZG, is the dominant real estate search platform in the United States. If you have ever looked up a home price online, you have probably used Zillow. Their signature product is the Zestimate, a proprietary algorithm that generates automated home valuations. By 2021, the platform was pulling 2.7 billion visits per quarter. That is the core business. An internet media company. Ad revenue, agent referral fees, asset light, high margin. In 2018, Zillow looked at that business and decided it was not enough. They launched Zillow Offers. The pitch was simple. A homeowner goes to Zillow, requests an offer, and Zillow, the company with its own capital, buys the house. Cash. Fast. No showings, no open houses. Then Zillow renovates the property and resells it on the open market for a profit. This model has a name: iBuying, instant buying. The industry had been pioneered by Opendoor, a startup that had been running this playbook since 2014. Zillow's thesis was straightforward. They had the Zestimate. They had the data. 15 years of home price information, more than anyone else in the business. If any company could price homes accurately enough to run a profitable iBuying operation at scale, it was Zillow. That thesis was wrong, but it took 3.5 years and nearly $1 billion to prove it. Here is how iBuying is supposed to work. You buy a home at a slight discount to market. Sellers accept a lower price for speed and certainty. You spend 4 to 6 weeks on renovation. You relist the property and sell at market, pocketing the spread after transaction costs. Your break-even economics, per Zillow's own stated targets, plus or minus 200 basis points. 2%. That is the margin of error the model was designed to operate within. Now here is what actually happened in Q3 2021. Unit economics swung to negative 2,100 basis points on gross profit per home sold. That is not a rounding error. That is a structural collapse. They lost an average of $80,771 on every single house they sold that quarter, on 3,032 homes. 3,032 houses, each one a confirmed loss before interest expense. The raw number, gross profit on the Zillow Offers business in Q3 was negative $245 million on $1.17 billion in revenue. Revenue is not profit. In this case, revenue was a liability. What caused this? 3 simultaneous failures that the model never anticipated. Higher than expected conversion rates are normally good news. In iBuying, they are a red flag. The shareholder letter is clinical about this. During Q3, Zillow experienced higher conversion rates than previously observed. Sellers were accepting Zillow's offers at a faster rate than the model predicted. Think about what that means. When a seller accepts your offer quickly, it usually means you offered too much. You were the best bid. In a competitive real estate market, being consistently the best bidder is not a sign of analytical precision. It is a sign of overpayment. The algorithm was generating offers that were systematically above fair value. Sellers, rational actors optimizing for their own outcome, accepted those offers. The algorithm logged this as success. It was not success. It was a slow accumulation of losses embedded in inventory. By the end of Q3, Zillow held 9,790 homes in inventory. It had 8,172 more under contract, houses it had already committed to buy but hadn't closed on yet. Nearly 18,000 homes, bought at prices the company now admitted were wrong. iBuying requires labor, contractors, tradespeople, supply chains. In the second half of 2021, those resources were in crisis. Post-pandemic supply chain disruptions had created shortages across the construction industry. Labor costs spiked. Materials were delayed. The renovation timeline, the critical holding period between purchase and resale, stretched. Zillow could not flip houses fast enough. Homes that were supposed to close in Q3 pushed into Q4. Revenue was deferred. Holding costs, property taxes, HOA fees, insurance, utilities, accrued on properties sitting idle. The model was built for a world with normal renovation capacity. That world no longer existed. Barton's letter to shareholders contains a number that deserves attention: 1,200 basis points. That is the swing in unit economics from Q2 2021 to the expected Q4 2021 result. 12 percentage points in 2 quarters. The stated design tolerance was plus or minus 200 basis points. Actual variance, 6 times the design tolerance in 6 months. Their model was built to forecast home prices 3 to 6 months into the future. That is the fundamental bet of iBuying, that you can predict with sufficient accuracy what a house will be worth in 90 to 180 days. During a global pandemic that froze the housing market, then generated an unprecedented price surge, then began to cool unevenly across regional markets, that forecast was impossible. They were not aware it was impossible until it cost them hundreds of millions of dollars to find out. The shareholder letter from co-founder and CEO Rich Barton is a rare document. Most corporate failure communications are exercises in blame diffusion. External factors, unprecedented conditions, strategic pivots. The language is designed to distribute accountability until no single point of failure is visible. Barton's letter is different. It is almost forensically honest about what went wrong. He writes that the original aim was to become a market maker, not a market risk taker. That phrase is important. A market maker profits from bid-ask spread and transaction volume, not from directional bets on prices. An iBuyer, by definition, holds concentrated real estate positions. It takes directional risk on home prices. It is, structurally, a market risk taker. The business model was internally contradictory before it launched. Barton also discloses a number that exposes the structural problem underneath the algorithm failure. Zillow was converting only about 10% of the sellers who requested an offer. 9 out of 10 walked away. That is not a pricing failure. That is a funnel problem. iBuying, by design, offers sellers a discount to market. Speed and certainty have a price. Most sellers, when they see that price, decline. That 90% rejection rate is not anomalous. It is the expected outcome of the model. Opendoor lives with similar numbers. The problem is what 10% conversion means at scale. To close one transaction, you underwrite 10. Each underwriting requires appraisal, inspection, offer generation, legal review. Each rejected offer is pure cost with zero revenue attached. Your operational overhead is 10 times your transaction volume. In a thin margin business where you are targeting plus or minus 200 basis points of break-even, that cost structure is not a feature. It is a slow bleed. Zillow's own IMT segment, the ad platform, was generating 43% adjusted EBITDA margins in the same quarter. The home segment was burning $381 million. Same company, same quarter. One business prints money by connecting buyers and sellers. The other loses money by becoming one. That was the contradiction, not the algorithm, the model. Let's run the complete accounting. Q3 2021. Home segment. Revenue of $1.2 billion. Loss before income taxes of $422 million. Adjusted EBITDA loss of $381 million. Embedded in those figures, a $304 million inventory write-down on homes purchased at prices above their future estimated selling value. Looking forward from November 2nd, 2021, the announcement date, Zillow guided for an additional $240 to $265 million in inventory losses in Q4. On top of that, $175 to $230 million in impairment and restructuring charges across the wind-down period. Consolidated net loss for the 9 months ended September 30th, 2021, $267 million. The homes segment alone accounted for $539 million in losses before income taxes over that same period. The core IMT business, the ad platform, the thing Zillow actually does well, generated $407 million in pre-tax income over those 9 months. That profit was being funneled directly into the losses of Zillow Offers. The profitable business was subsidizing the failing one, quietly, at scale, for 3.5 years. When Barton writes in the letter that the core IMT business thrived while we poured its profits into the Zillow Offers iBuying operation, that is not a metaphor. That is the income statement. Total headcount reduction, approximately 25%, 2,000 people. Zillow's stock fell roughly 25% in the immediate aftermath of the announcement. The company that had tried to disrupt real estate had instead disrupted itself. This is not a story about a bad algorithm. The Zestimate is a genuinely sophisticated tool. It works well for what it was designed to do: provide a reasonable home valuation estimate to consumers browsing the platform. It was built on years of transaction data, neighborhood comparables, property characteristics. The failure was not algorithmic precision. The failure was operational deployment. There is a concept in systems engineering called domain drift. When the environment a model was trained on diverges from the environment it is deployed in. The Zestimate was trained on historical transaction data. It was deployed into a market experiencing a once-in-a-generation disruption, a pandemic that simultaneously froze supply, compressed inventory, spiked remote work-driven demand in new geographies, triggered an unprecedented home price appreciation cycle, and then began to deflate unevenly. Historical data could not model this. No model trained on pre-2020 transaction history could have predicted the 2021 housing market. The backtests were clean because the training data was clean. The real world was not. The secondary failure was organizational. The conversion rate signal was available in real time. When your acceptance rate rises, you ask why. You check whether your model is bidding above market. That check either did not happen or did not reach decision makers fast enough to halt purchases. By the time the write-down was recognized, Zillow had already committed to nearly 18,000 homes. The inventory was the evidence of the failure. The failure had happened months earlier, one offer at a time. There is a final layer to this that the financial statements make visible. Zillow's debt at the end of Q3 2021, $4.4 billion. Much of this was the financing structure for Zillow Offers. The company was borrowing against its home inventory to fund acquisitions. This is not an unusual structure for an iBuyer. Opendoor operates similarly. The problem is what it means for the exit. When you wind down an iBuying business, you are not selling a software product or closing a service. You are liquidating a real estate portfolio. Thousands of individual properties across dozens of markets needing to be sold in sequence in a market that knows you are a distressed seller. Zillow had to sell approximately 9,000 homes in Q4, while simultaneously accepting another 9,000 homes it had already contracted to purchase before the announcement. It was filling one side of the bucket while emptying the other. The company expected this wind down to be at least cash flow neutral. That is not confidence. That is a floor. It means they believed they could exit without burning additional cash beyond what was already lost. Whether that floor held would determine whether the damage was survivable. The core IMT business, still generating north of $200 million in adjusted EBITDA per quarter, was the reason the company could absorb this. Without that profitable platform underneath the wreckage, this is a bankruptcy filing, not a press release. On November 2, 2021, Rich Barton held an emergency investor call. He said the company had determined that the unpredictability in forecasting home prices far exceeds what we anticipated. Far exceeds what we anticipated. 3.5 years. Billions in capital deployed. The most data-rich real estate platform on earth. And the conclusion was, houses are hard to price. That is not a technology failure. It is an epistemological one. The system was so confident in its own model that it scaled the bet before the model had been stress tested against the kind of conditions that actually destroy bets. The Zestimate is still live on Zillow's website. It still generates home valuations for millions of properties every day. The difference is that no one at Zillow is buying those homes anymore. Subscribe to the White Collar Autopsy. We'll see you in the next dissection.